Okay, so hello and welcome back. We have been covering a couple of topics around business conversations and business coaching. We started with talking about whether business coaching is a cost or an investment. Then we spoke about how does business coaching actually work. Then we spoke about the different stages of an organization, whether it's a growth stage, whether it was the startup stage, growth stage, or the recovery stage, and how business coaching is different for each of these stages. Today, we have a very interesting topic. Today, we're going to be talking about what is it to have a profitable revenue growth. Now, the key word over here is not revenue, or growth. The key word over here is profitable. So many an organizations actually are, especially in the early stages, are chasing the revenue numbers. They're looking at their revenue growth. They're looking at the revenue goals, right? Over a period of time, what happens is they lose their sight on the profitability. And this would mean that you can, while you have huge revenues, you have huge billing happening, you're actually not earning that amount of or that percentage of profit. So this is what we mean by how about a profitable revenue growth, and how can we as business owners ensure that we do not fall in this trap of only chasing the revenue, but look at a growth which includes profitable and revenue growth. So, CK, would you want to share some of your insights some of the cases that you've been working about with the similar situations?
Sure. I think Neetu, you already covered the fact that I think, in the early stage, obviously the focus is on market penetration, the focus is on getting your product or service out, focus is on gaining clients, So obviously a lot of cost goes into it in terms of marketing cost, in terms of sales team cost, in terms of branding, in terms of lead generation, and all the things which are required, obviously, to penetrate the market. So in the first 1 or 2 years, obviously the focus is less on the profit and it's more focused on the revenue.
Correct.
But as you get into the next phase, which is the companies which have been around for a while, which are in a growth phase, not talking about 15, 20, 30% or 40% growth in revenue, right? Here again, unfortunately, what happens is the old habit of just focusing on getting orders, getting billing, getting collections, right? So these are three things which everybody keeps focusing on: how much orders have come, how much of billing has happened, and how much of dispatch has happened, how much of collection is happening.
Mm-hmm.
Now, in the process, what happens is that quite often when I'm working with entrepreneurs, I keep asking them in terms of, so how much money did you make last month? We have no idea. How much did you make last quarter? We don't know. How much you made last year? It's there in the balance sheet. And I said, look, balance sheet is historical data, right? It's a good indicator figure to have. Your accountant will give you those figures. But if you're running a business and on a monthly basis, you don't know how much money you made at the end, right? How are
Mm.
you going to run your business well, right? How are you going to run your business tightly? So whether it's a growth phase organization or a recovery phase organization, you know, there are certain fundamental things that need to get done so that they really know that when I'm doing business and making good money at the end of it, so that I can reinvest that money back for hiring, for training, for marketing, for branding, for market expansion, for exhibitions, and all the things that are required to grow the business, right?
Correct.
If you don't make enough money, then how do you invest the money, right? So we get caught in that vicious cycle of I don't have money, so I can't invest. I can't invest, so I don't get growth, right? And I don't get growth, so I don't invest. I keep looking at cutting costs. So
Got
we
it.
had a very simple way of doing this. I told the clients, look, you are now working in these four regions of, say, South, since we handle many of the clients sitting in Bangalore. The tendency is to cover the southern region more than maybe the northern region or the western region or other regions, because there's a lot of cost attached to that.
Mm.
So I said, look, you are in four states of South India, right? Tell me, do you know how much profits you make in state number one, state number two, state number three, state number four? They said, no, we never got down to that level of detail.
Mm-hmm.
So I said, why not? Right? What's stopping you from getting to that level of detail? Geography wise profitability. Look at your revenue in this region. Look at your operating costs. Allocate your other costs, which is your production costs, manufacturing costs, all the back end costs, based on the revenue that you're getting. So that you know that in state one, I'm making 30% margin. In state two, I'm making 10% margin. In state three and four, I'm actually losing money.
Hmm.
And that's actually what happened. When they actually did that geography-wise profitability, it was quite an eye-opener for them. That
Correct.
they've been in two states for the last 3 or 4 years, and they never realized that they're actually losing money. So I said, why are you doing business in a state where you're losing money?
Hmm.
Either you make it a profitable operation or you get out of that state.
Got that.
Now, that was a bit of a shock to them. Or relook at your model, right? If you think you're not making profit because your cost base in that state is too high, you have too much of a team, too much of fixed costs, but your revenue is not matching. I said, then relook at your model. Maybe go for a distribution model so that you have less manpower, but you're still able to get the market coverage, right?
Hmm.
So it brought about a change in the thinking that look, I can look at profitability by geography.
Got that.
The second aspect I brought about was in terms of saying that look, which are your products which contribute 80% of the revenue?
Hmm.
There were about 7 or 8 or 10 products out of the total product range that were contributing bulk of the revenue. And I said, look, are you making profit on those products? Which is your most profitable product? Which is your least profitable product? Again, they did not have the data,
Hmm.
but they were able to go back to the drawing board, go back to production, go back to this, and figure out that look, on some of these products I make 30% gross margin, and some of these products I make only 5% gross margin. Some of these products I'm selling at cost.
Hmm.
So they were able to prioritize which products they should be focusing on more, and the products which had a lower margin, how they could look at how to improve those margins through
Got.
better negotiation with vendors, etc. Right?
Hmm.
The third part was to cover the market, they had to go through channels.
Hmm.
They had to go through distributors, they had to go through dealers, they had to go into e-commerce, they had to go into exports. And obviously, the margins are different in each. If you're dealing with large modern retail outlets, or you're dealing with e-commerce firms, right? Obviously, their model is giving good prices to the consumer,
Hmm.
which means they're obviously going to squeeze you on the price you give to them, right? So your margins with them are going to be much, much lower, but your volumes are going to be higher.
Correct.
But you're conscious that in this particular segment, I will make only 5 or 10% margin. But in the other segments, I make 15 or 20 or 25% margin. So that overall, I make say 15% or 20% margin, right? So when you start looking at geography profitability, start looking at product profitability, and you start looking at channel
Channel.
profitability, suddenly what happens is that every aspect of business is looked at from, is it profitable or not? Should we be
Correct.
doing it or should not be doing the business, right? And sometimes what happens is where they find that the profitability is low, it means going back to the drawing board and saying, look, maybe our cost of providing the service is very high, or cost of procuring these items is very high. So it again goes back to purchase or procurement, renegotiating with vendors, getting better terms with them, adding more vendors to the kitty so that they're able to negotiate better pricing. So even a 5% saving, 4% saving, 7% saving there straight away adds to the bottom line,
Makes
right?
sense.
So I found that by just a simple methodology, it sounds simple, but it does take 5 to 6 months or 7 months for this whole clarity in terms of revenue and figures to come in, so that at the end of it, in fact, many of the entrepreneurs that told me, look, we never had this kind of control on our business earlier. Now we know exactly where we are, we know exactly what we need to do to get to the destination. So there was a client who been in business for a long time, making 3 or 4% EBITDA. So I said, why are you doing business at 3 or 4% EBITDA? So
Hmm.
they set a target, we should at least get to 10% this year, and we should aim to get to 14, 15% the following year, right?
Makes
And
sense.
believe me, Neetu, I think at the end of almost, I think, 2 years of hard work, they reached a 10% EBITDA figure from a 3%. So,
Absolutely.
it didn't happen overnight, but because they were focused so much, now you ask them how much profit you made the previous month, they will know, right? And so they sort of mapped their market, their product, their everything. And I think so it's not difficult for a small business or a mid-sized business to bring in this profit culture. So even when the market conditions are bad, like it is say right now, right, we may have wanted 30, 40% revenue growth, but market conditions don't allow more than 10, 15% revenue growth. Does not matter. Even with the 10-15% revenue growth, we should maintain the bottom line
Correct.
through better management of resources and
Correct.
costs. Yeah.
Correct.
So that's
Interesting.
what I wanted to really share. Yeah. Yeah.
Interesting, right? So maybe you've spoken about profitability when it relates to geography, to products, and to channel. I would like to add a little one more aspect to that, which is profitability as per clients.
True.
Many SME organizations are in this space where more than some they have a client who's giving them more than 50% of their business. Okay, and then they have a smaller individual clients, and invariably this one large client for them, when they start looking at the profitability client wise, they realize that this client is actually their profitability is low. The reason being that it requires more resources to service.
True.
They being a larger organization, they really negotiate down on prices, right? And the third one is again being a larger brand. There's a lot of demand that they have, include from having excess, having buffers of either extra stock kept nearby, time to service them, the number of resources to service them, etc. So
True.
the cost of doing business with a larger organization is actually increases. And whereas when you compare it to the smaller organization, they may have five, six, a larger number of smaller organizations, but the profit per customer is actually much more higher. So if you see, what happens is many a times the profit earned by the smaller organization feeds the servicing of the larger organization, and that does not make any business sense at all, right? So it requires, once we start looking into the per customer profitability, there is again, it's another eye opener, and you realize, hey, why am I doing business with this large organization,
True.
right?
True.
Is it because of the brand? If there is a brand value, the brand value should be converting into more revenues from other accounts, from other
True.
businesses. If that is not happening, you have to really ask yourself why you're doing that business. And remember, the moment we're working about a large organization, it means year on year, we are looking at reducing their own costs. That means they're going to squeeze you more on money year on year. So that means you, even though your revenues may increase over there, your profitability will actually be reducing on a year on year basis, right? So that's another aspect which I feel many organizations fail to see about the profitability per customer, right?
Absolutely. Absolutely. So in fact, while I did cover the fact that there's a geography profitability, there's a product profitability, there's a channel profitability. I think there are a lot of organizations, like you mentioned, Neetu, that they get mostly 40-50% of their business from one or two clients.
Hmm.
And I always warn these entrepreneurs, look, that's an extremely dangerous strategy that you're following, right?
Absolutely.
If that client decides that next year we want a 5% reduction in our costs and they add more vendors, right, the margins are going to get further squeezed.
And I'm
You
sure
get to a
everybody will
point.
relate to that. It
Yeah,
happens.
yeah,
Everybody will
it
say this
happens,
stuff
right?
happens.
You not only get squeezed on your price, you get squeezed on your commercial terms, payment after 60 days, payment after 90 days, 10%
Correct.
retained and paid after 6 months. It's a good formula to mess up your complete financial model,
Absolutely.
right? In that desperation to get those few crores of business in a year, right, you incur so much of cost. And in fact, I have clients who do a lot of this B2B business with large corporates and large hospitality sector clients. And I kept asking them, you're getting this 1 crore deal, you're getting this 2 crore deal, it sounds very nice. We can all celebrate, we can clap, we can go for a party. But end of it, on that 2 crore deal, how much money did you make? And say, we have not looked at
Hmm.
it. So sometimes it's so shocking that in that quest of running behind that big deal, uh, so I brought in the concept of, if this is going to be a project by itself, have you looked at the profitability of a particular project? You might be
Correct.
doing 8 projects together or 5 projects at the same time, but it's quite possible in 3 other projects you're actually losing money. 2 other projects you're making some money.
Correct.
So now they've brought in that whole thing about that before they finally negotiate and arrive at a price, they know that at this rock bottom price, which I'm going to give this client, I will still make a 10% margin or 12% after covering all my costs.
Correct.
my sales cost, my distribution cost, my channel cost if I'm involving a channel partner or a consultant or a partner. And if I find that my margins are very low, I need to go back to the drawing board and say, look, I need to reduce my procurement cost,
Correct.
or I need to relook at my manufacturing process. I need to relook at my headcount and manpower and productivity in such a way that if I have to give to the client at X price, I need to be at zero point 0.8 or zero point 0.7x or zero point 0.6x in such a way that I'm able to give the client the price that they want and still make money.
Correct.
If I'm going to give the price the client wants and lose money, then why do business at all? Now,
Correct.
so this again is a cat and mouse thing that no, I want that big business, but in the process, I'm compromising so much, right?
Correct.
I get my money after 3 months, sometimes after 6 months, sometimes there's so much of dispute, 10%, 15% gets written away. And
Correct.
that might have been my margin in the deal in any case, right? The entire
Correct.
margin gets written away because I don't get the money on time, right?
Correct.
The cost of interest and everything else. So I think this
Absolutely.
is a very important point that you brought out, Neetu, that deal wise profitability or project wise profitability, particularly when dealing with very large clients. We need large clients. Small businesses need large clients. Large clients need small businesses,
Correct.
right? But often the relationship is unequal, right?
Correct.
Because the clients are big, they take advantage of the small people, and the small people tend to compromise because they want it. So I'm saying you don't have to compromise. You sort of make sure that I need to be competitive. I need to be able to win the deal, and I need to win the deal and make profit.
Correct.
Maybe a lower margin, but that's a conscious decision.
Absolutely.
But not at a loss. Not at a loss.
Correct.
Otherwise, your balance sheet is going to get messed up because you will show a lot of revenue, and that revenue is not contributing to the bottom line.
Absolutely.
And when you put it all together, if at the end of the month or end of the quarter, end of the year, your business has not made money, right? How are you going to reinvest back for growth? Right?
Correct.
How are you going to
Absolutely.
plan for the next year's business plan? I want 40% growth next year. I want to increase my EBITDA. I want to sort of cover more markets. I want to go international. I want to hire more people. I need to get more inquiries. So I need to spend on marketing and branding. Where's all that money going to come from if your business is getting squeezed at the bottom, right?
Got that.
So I think as business coaches, what Neetu, you and me and others are able to bring about is a conscious shift in the approach from just running after revenue, like you mentioned at the beginning, to running after what I call driving profitable revenue growth.
Makes sense.
Big difference between driving revenue growth and driving profitable revenue growth. It's only one extra word, but
Mm.
the amount of effort it takes is like almost a culture change in the way the organization has to really uh, structure itself.
Got that.
Almost like almost has to reinvent the way they do business. And I
Got
think that's really what the whole thing is all about. Yeah.
Makes sense. So, in fact, one what I want business owners to be conscious about is this: that when you are looking at your balance sheet and your profit and loss, and when you have lump sum figures over there, so we're looking at the overall revenues, the overall profits. That is never the true that's not a true indicator of your organization's health. It's only when you break it down to saying what is the profitability, like you said, geography wise, channel wise, product wise, client wise, deal wise, project wise. When you start building kind of breaking the numbers down to these, you realize that when you use a lump sum number, you're averaging out everything. You're averaging out your profits, you're averaging out your losses. So while we do that, so while as an it may be required from the government requirements as a business, for you to realize whether you're actually earning profit is to break it down. And this is go into three levels of depth as in inside the depth of the numbers. Now, the moment you do that, you will realize, like you said, certain channels are not working, certain products are not working, certain geographies are not working, certain clients are not working out for you. It becomes so clear that the profits that you're earning from one segment is actually getting utilized in another segment, and that is actually reducing your overall growth. And this would mean once you've identified this, is for you to take a hard decision that which geographies you may want to let go, which products you want to stop manufacturing or stop servicing, which clients you want to move out of. It's a hard decision to make, but the moment you
Yeah.
start looking into these numbers, you will become so clear that if you do not do this, you will not see that exponential growth for your organization, which is beyond just revenue, but also includes the profit as such, right?
Yeah,
That's
so in fact,
one.
that's what you're talking about. No, all the things that you just spoke about, Neetu, is really about reinventing the way you do business, right? And I think
Absolutely
that is a topic by itself. I think which we should cover in the next session, because
correct.
it's about re-looking at the entire way you do business and why you do business and what are you doing
Absolutely.
business for, right? So I think a lot of that I think we could possibly cover in the next video.
Absolutely. So that means our next topic is going to be about how can business coaches help you reinvent your business, right? And we see you again next week, same time.
Thank you for
Thanks.
your time. Thank you so much. Yeah,
Bye.
bye.